In this video, we're going to take you through what's been happening this week in the economy that's going to impact us and you as property investors.
Hi guys, I'm Jim and this is Dan, and we're both property investors based in the northwest of England, and we're going to document our journey to financial freedom through property on this channel.
Two big things that have been happening recently in the economy is inflation and the potential recession. We've seen big action on this week from both the Bank of England and the Chancellor. If we start with the Bank of England, we know that the base rate has increased by 0.5% to 2.25%. What is interest rate? Well, quite simply, an interest rate is the cost of borrowing debt or the return you get on your savings. The Bank of England base rate impacts and filters through into high street banks and affects you as borrowers.
So historically, since 2009, which was the last global recession, interest rates in the UK have been historically low, typically around about 0.5% and even going lower. But at the start of 2022, inflation was sky high, so the only lever the Bank of England can really pull is to up the interest rates, which is what happened. So if you're sort of our age, sort of millennial, early 30s, late 20s, you will have never seen interest rates go up, and you will have never seen high interest rates. And this is where, if you speak to people who are maybe in their 50s and 60s, they'll tell you about the late 80s and early 90s when they had like a mortgage interest rate of 15%. So mortgage payments were sky high. Obviously for us at this stage, that's pretty much alien to us. We've never experienced that. We've been used to interest rates of 2-3%. And this is where, as a property investor, over time, inflation will pay this down, because inflation is always higher than the interest rate you pay on your mortgage.
So Friday the 29th of September 2022, we've had a mini budget. Liz Truss has been barely in power 2 weeks and we're already seeing big economic changes.
So one of the first things that's going to happen is from the 6th of November, the 1.25 national insurance increase is going to be reversed. Now, Rishi Sunak, the former Chancellor, put this in place, and this is obviously to pay back the COVID debt, which the UK took on, like most countries around the world, to pay for the lockdowns. So this is being reversed, so there's going to be a 1.25% gain back for people on national insurance.
An additional thing which was announced today in the budget, which is very interesting to property investors, is that stamp duty for people buying residential homes, the point at which you start paying that has increased from 125k to 250k. Particularly interested for investors who invest in areas where the housing stock is particularly low and they're buying houses below 250k. They're going to be competing with buyers of homes who want to purchase those properties. Obviously, stamp duty is still applicable for people buying buy-to-lets.
Next up, from the next financial year, which is April 2023, the basic rate of tax is going down from 20% back down to 19%.
That's not the only thing that was introduced as part of tax changes. The second thing was the uppermost level of tax, which is 45% on earnings over £150,000, has been scrapped. So those people will now pay the reduced rate of tax of 40%.
Finally, another key piece of information for property investors is the proposed corporation tax increase to 25%, which was a Rishi policy, has been scrapped. It's staying at 19%, which is good news for everyone in a limited company, which should be most property investors nowadays, being honest. And this feeds into the broader narrative around why Liz Truss and her cabinet are doing this, and it feeds into the theory of trickle-down economics. And this basically means the more money there is in the bucket, the more money there is swilling around the economy, and it all works its way down to the people. So this is why there's been tax cuts, national insurance cuts, stamp duty relief, corporation tax isn't going up. It's so more people have more money to spend, which in theory should grow the economy.
So let's dive into some of the details of what interest rate increases mean for you as a property investor. In relation to mortgages and loans, let's say you had a loan of £100,000. If you had a 2% interest only mortgage, you'd be paying £2,000 a year, which would work out at roughly £167 per month. If that jumps up to 4%, obviously that's £4,000 a year, and that's £333 per month. So you can see how small interest rate changes can really impact you as a property investor. So what do you do to mitigate against increased interest rates? Well, whenever you're doing any property deals, you should be thinking about stress testing the numbers. What we mean by a stress test is you see that the rental coverage that you're getting from the property will mitigate against any increases in mortgage payments. So for example, we would use a 6% interest rate and ensure that the mortgage is covered 135% of the rent. There could be some potential benefits for property investors with the current economic situation. There's a cost of living crisis, energy bills are going up. Some people might be thinking about downsizing their homes because the cost of living is just too much. This might mean there are more opportunities for assisted sales or people who are getting into arrears with mortgage and need to sell quickly, therefore potentially opportunities for below market value deals.
So it's obvious for us as property investors that we need to keep an eye on the macroeconomics of the general economy and where interest rates and inflation is at, because that can help inform our investment decisions. So with that said, if you want more of these type of videos, please make sure you subscribe to the channel and like this video so we know you like this sort of content. And we will see you guys in the next video. Cheers.